Hello, my name is Steve. I'm with 123. I'm here to do the initial training. What I want to start out with first is a formula, and the formula is this: the cost of attendance minus expected family contribution equals remaining need. What that means, I'm going to go through the definition now of what it means. The cost of attendance is tuition, fees, room, and board. There are mandatory fees at every school. Depending on what your major is, those fees might be more or less. What we do not include in our report are the additional expenses, such as books, transportation, and wardrobe. Those could be up to $5,000 more. We don't include that in our cost of attendance because depending on the major, depending how far you live from the university, and depending on the environment you're living, your books and your transportation and your wardrobe might be more or less, but it's around $5,000. What schools will do is they will include that $5,000 in the cost of attendance. And the reason why the schools include that is because that allows the parents to take out the parent loan for undergraduate students, or the PLUS, where parents can borrow up to the total cost of attendance less any aid the school is providing. So that allows the parents to borrow money to buy the books and for the transportation and room and board. And additional expenses like wardrobe. So that's cost of attendance. Next, you have a term that's defined, or remaining need, as EFC, expected family contribution, which is the minimum the family is expected to pay before they qualify for financial aid. There are two methods. One is the federal methodology that requires the FAFSA. The other is the institutional methodology that requires the CSS profile that I will discuss with you later. So if you take the cost of attendance and you subtract the EFC, you're left with remaining need. So let's say you have a school that costs $65,000 a year, which you might say is a little bit too expensive. Let's subtract an EFC of approximately $15,000. The reason why I'm using $15,000 is because if you have a parent or total family income of around $100,000 a year, your EFC will be approximately $16,000. So let's just say $15,000 for number's sake here. If you take the $65,000, subtract $15,000, you're left with $50,000. There are schools out there, believe it or not, that will cover 100% of remaining need, or $50,000. A lot of people don't understand that. But if you can show a family how they might be expected to pay $16,000 and go to a school that's $65,000 or $70,000 instead of going to a state school for $16,000, then they might be willing to reposition assets, or the student might be willing to try harder to get a high GPA in high school and good SAT or ACT scores to get into these better schools. So what we are going to do in this program is show the families how to understand that. So we have the promise here. This is what every family will sign. We recommend that they charge $1,695. Now we charge $845. Anything above that is sent back to you as a marketing allowance or a rebate for providing business to 123 College. It is not commission. You do not collect the monies in your name. It is all collected and sent to 123 College. And the bottom of the questionnaire, on the bottom of the promise, you will see that we have the payment. So they should make it all out to 123 College if it's a check or not. Now, I just stated the $845. You could charge $19.95 if you like. You can make a request and we can send you a Word document where you can change that price. The only thing we don't want you to do is to change the terms of the return policy. The return policy is very straightforward, but I'm going to go through it with you now anyway. We will refund the cost minus the 10% restocking fee within 30 days of the family receiving the report. However, if we do not receive a questionnaire within 90 days of receiving the payment, we will not provide the refund. Believe it or not, if you do not have people complete the promise, they will not complete the questionnaire. We have promises that have been completed that have been sitting with us for more than 90 days. We contact the families on a weekly basis, but they just do not complete the questionnaire. If you hand the family a questionnaire and do not collect the promise, the odds are that they will not complete the questionnaire. So if you change the cost to $16.95 to $19.95, you will receive $1,150 back. If you reduce it to $12.95, you'll only receive $450 back. We require $845. Any additional student in the family, we charge $450. So for any additional student in the family, if you charge more than $450, you will receive that difference back. So that's how the $16.95 works. We do have some affiliates that charge $29.95. That all depends on the area where you live. We provide the student profile report, which you have received a hard copy of, and you can always go onto our website with your username and password and download another copy of the sample report. I will be going through the sample report, the sample report with you today. Now, when we generate reports for families from the questionnaire, every report is different. But what we will be going through today is a sample report. 80 to 90 pages long. It's very in-depth, and it saves the family hundreds of hours worth of research. We also calculate the expected family contribution, which I just said is the minimum the government expects a family to pay. Many guidance counselors make it seem like it's a very straightforward process, but guidance counselors don't understand the financial aid issues with income and assets. I worked at a high school for 5 years as a physics teacher. I offered what they call a brace advisor down here in the high schools, help with financial aid night. All we did was herd the family into the computer lab, help them to log on to the FAFSA, complete it, and sign it. There was no talk about EFC ramifications. And what I noticed is that students in this school that I taught had very low EFCs of $3,000 to $5,000, but they never thought they were going to get into the better schools. So they never really had good GPAs, and it really hurt me to see these students who were paying $3,000 to $5,000 EFC go into community colleges. So that's what brought me, one of the reasons why I came back to working here at 123. There was something called the CSS profile, which uses the institutional methodology. The institutional methodology is required by the better schools in the nation. These schools provide up to 100% of remaining need. The family can feel free to fill out the CSS profile themselves. And they should feel more than free to do that. And they can even give us a call. But typically, and I might be saying that more than once during this training, after 10 phone calls in 3 days, they give us a credit card authorization to charge them $225 to file the CSS profile. It is a monster to complete. If you haven't looked at one before, it's very intimidating. This college board, the CSS profile, is sponsored by the college board. They have a monopoly on the CSS profile. Whether we file it or the family files it, they must pay, this is the family, pay $9 to register with the college board and $16 per school to send it to. That is not included in the $225. There are some students that want to apply to 10 CSS schools, and that would be $169, and that does not come out of the $225. If you have children who took the SAT or will be taking the SAT, you will notice that they have to register through the college board. So this is not a magical company. It's been in existence for a very long time. Now, in regards to a college search, I have a 3,000-page book in front of me. The last time I bounced it off the table, I accidentally hung up the phone. But this is the Peterson's four-year colleges. Basically, 3,000 pages, alphabetized by state, and then alphabetized by school in the state. They don't put them in the order of remaining need provided. They don't put them in the order of graduation rate. They don't put them in the order of faculty-student ratio. It's very difficult to search for colleges in that way. One can go online and register with a bunch of different websites and get possibly good information, possibly bad information. But there's one thing I will tell you, you will get your email address and your information all over the web, and you will end up with a lot of spam emails. I first did research for 2 years that way just to check out what information was available, and I eventually had to change my email address because I was receiving so much spam. We could save the family hundreds of hours worth of research. With our database, we can not only narrow down our college search by area of the country and state, but we can narrow it down by major and by amount of remaining need provided. So we can filter out and show the schools that provide 100% of remaining need or 80% of remaining need. That's very important because if people don't understand what remaining need means in their situation, then they're basically lost. So we can take the formula cost of attendance minus EFC's remaining need. But if one does not know how to apply it, then it's not really going to help. We also critique essays. We do not write essays. We do not charge $1,000 or $3,000 additional to help a student write an essay. But we do provide students with an outline and tips on how to write an essay. Once the essay has been written for college, we will then critique it. Many schools put as much weight on the essay as they do on your GPA and SAT scores. If one writes a poor essay, one will most likely not even be admitted to the school. I was just making sure I was recording. And if you see it, I am recording. Next, we negotiate with colleges. What that means is that at the end of March, early April, if not later, when the families start receiving these aid packages from the schools, they send them to us and we evaluate them. We receive hundreds of aid packages every year. For us, it's easy to evaluate because we know what the EFC is for each family. We know what the amount of remaining need that's provided by each school specifically. Then, if necessary, we draft a letter that the family can then send to the school to ask for more financial aid. I will get into more detail with that later on. We also provide the SAT or ACT study guide and online access. I would ask anybody this question. If you run 2 miles every day, does that prepare you for a 26-mile marathon? Probably not. The whole idea is to take practice tests over and over again until one gets used to the type of questions that are asked and develops the stamina to take a 2 or 3 hour test. The better the SAT or ACT score, the better school the student gets into, the more financial aid they receive. We also provide an online college and career assessment program, which will help the student graduate in 4 years. I will go into that more in detail later. We help families understand about loans and where to get them from and how they have to be repaid. We do this for the parent and the student. You will eventually become a senior college counselor. This is not the first training. This is the first training, but not the last training. We will ask you to take a quiz online after we go through the training with you. We will then go through your seminar with you. We are going to ask you to email us a request for these slides for customization. We will email you a 22-slide or a 23-slide presentation and review it with you over and over again before your seminars. We also have a pre-recorded seminar, and we have a pre-recorded seminar overview on the website. We take the burden away from you, by the way, because we provide our toll-free number. Many affiliates choose to just sign a family up, reposition assets, and not want to deal with them again. Well, that's okay because the families can call us and affiliates can call us. We love to answer questions. We've been around since 1994, excuse me. That was a little slip there for some reason. So we can answer any questions they might have if you do not choose to deal with them. What we also do is we send them letters. This is the family. Every year in September, ask them to provide us with their updated FAFSA information. The FAFSA needs to be filed every year. You as an affiliate do not need to be a part of the yearly FAFSA filing. It's no charge to the family, no charge to you. This is what we do as part of the program. Now, in regards to filing the FAFSA, it is not the Wild West. We do not take their authorization form with their updated numbers, just throw it onto the Department of Education website and hit enter. We take the family's authorization form and we put that information on the FAFSA. We then send it to the family to review, and with their okay, we then submit the FAFSA. In that way, we can avoid a very, very large percentage of errors. The last thing one wants to do is submit a FAFSA and then have to go back and make corrections. It's not that corrections can't be made. It's just that if too many corrections are made, it could get lost at a school's financial aid office. So filing it once and filing it correctly is the best way to go. Now, there's a lot of information, a lot of people scared about people sharing information. Well, any information that's provided by the family will only be shared with the affiliate and with us. We do not share it with anybody else. We do not sell information. We do not sell email addresses. Everything stays with us. Now, let's talk about the report itself. This is a report that every family will receive. I just moved it somewhere. That every family will receive and that we will go over with you. When we generate a report, we first receive the promise in the questionnaire. We then develop the report and we email it to you, and we review it with you to make sure no changes are necessary. And if they are, of course, we'll make the changes in a PDF format. Then we review it with you, and upon your approval, we will send you the report. We will send you the SAT, ACT study guide. We will send you the college and career planning login information. We will send you the marketing allowance or the rebate check. You then deliver the report to the family. Excuse me. We go over every single report with you until you are comfortable. Some affiliates, it takes just one time. Other affiliates, it takes 2 or 3 times. Other affiliates, we have to review every single report. We have done thousands of reports for families. We are very familiar with how to take with each approach. We are going to go through a sample report with you today, including different approaches for this family. But we need to go over the report with you. The first thing I'd like to clarify in the report is that we do not make any recommendations. We have nothing to do with FINRA. We sent our report to FINRA to get an opinion. It cost $4,000 or so. And FINRA came back with no opinion. We don't have anything to do with making recommendations. And that's the very first page of the report. We developed a report from the U.S. Department of Education Needs Analysis Formula and from the questionnaire that's provided by the family. We are in no way affiliated with a broker-dealer. Any information that we provide is separate and distinct from strategies provided by financial advisors. CYA have the parents put their name and sign and date. It's not for us, that's for you in case any family raises an issue later about you giving them advice from our report. Earlier, I'd gone over the additional costs, so I'm going to skip this page. I touched on the CSS profiling. I touched on the FAFSA filing. This is all for the parents to understand. I am not going to go through the authorization form with you because you'll be receiving that, or the families will be receiving that in September of every year. If you sign a family up after September, don't worry. There will be an updated authorization form to be completed and sent to us. But on page 7 of the report, it's always page 7 that I just highlighted. Maybe you can't read it. I just highlighted it again. Always page 7, always page 1-1-1. We want the families to sign up even before 10th grade, but let's say they sign up in 10th grade. They would understand why they should keep their GPA nice and high or get it to be nice and high. They should understand why they should be taking the SAT or ACTs multiple times. And they should be able to choose a major before they go into college. I'll explain that in more detail later. So in order to get the most use out of this program, they should really start in 10th grade. And when I go into further explanation of EFC from income, it's important to get them started even before 10th grade. But if they pay the $16.95 or whatever they pay, they should take advantage of the subscription as early as possible. I'm not going to go through the personal financial aid plan because we're going to go through that during the rest of the training. Every family is going to go see the colleges. It's very much expected. They're going to be sold on the colleges. Of course, they're going to be shown the nicest dorms, the nicest dining halls. They're going to be shown the nicest lecture halls. They're going to be sold on the school. But sometimes a family might see the financial aid officer. What we tell the family is if you decide to speak with a financial aid officer, which we do not recommend, they should at least know the answer to this one question. What is the percentage of remaining need net? We provide this to every single school that the student has chosen and schools that we pick for the student as well. This is the last page of the questionnaire that I just brought on. It asks for the student's GPA. It asks for their class rank. It asks for their SAT and ACT scores. It asks them what their interests are academically. It asks them where they want to go to college and what they'd like to major in. It allows us to choose other schools other than maybe the 3 that they're going to pick. I'm going to bring this questionnaire up one more time just to show you what I'm talking about. There's a place on the questionnaire to list schools. We will list up to 9 schools in every report. So if a student only picks 6, don't worry, we will add 3 more on. If the student only picks 3, we will add on 6 more. We want the students to understand that they can go to better schools, and once you review the report with them, you will show them why they might want to choose other schools afterwards, which we will rerun reports. Additionally, if we do sign a student up in 9th grade or 10th grade or 11th grade, that's not the end of what we provide. We certainly ask the student to get back to us in the summer before the senior year of high school and maybe ask us to run a new report with updated school costs or even maybe new schools, and we will do that electronically free of charge a certain number of times within reason. If it hits the 4th, 5th, and 6th time, we will start charging them, but the 2nd, 3rd, and a few more afterwards will be done gratis. Why plan for college? Well, you have to develop a workable solution, and we're going to go through that today. Here is the Kuder Navigator. It's called KUDER. My email address and any operations email address is going to be info, I-N-F-O, at the numbers 123college.com, info at 123college.com. You can send me an email asking me, please send me Kuder, which I just highlighted there so you know how to spell it, and slides to customize. And we will send you the slides for you to customize. It's only 2 slides to customize that we generate the your workshop seminar with. And we will send you the login information for Kuder Navigator. There are some very interesting numbers in regards to graduating college. 50% of students graduate in 4 years. That might sound great, but guess what? That means 50% of students aren't graduating in 4 years. 35% of students drop out in their freshman year. I guess because they just weren't ready and they didn't even know why they're going to college. 67% of students graduate in 6 years. That's really not that good. That's crazy, because if you're paying, let's say, $25,000 a year for school, and you go for 2 extra years, that's $50,000 tuition. Now, if you're not working those 2 years, and you're conservatively not making $25,000 a year, now it's $50,000 out of pocket for college and $50,000 lost income. If you graduate in 6 years, it's going to cost you net about $100,000 more. We want the student to choose their major before they go in. Now, Kuder is great. The student takes a 25-minute personality test and a 25-minute aptitude test, 2 separate tests. Kuder combines them together and shows the student what they might want to major in. And it allows the student to research each major to narrow that down. So if a student can go into college knowing what they're going to major in and not switch their major, their odds of graduating in 4 years are much better. Kuder could be worth thousands and thousands of dollars. We strongly recommend that student takes a complete use of the system. If you would like, you can take the login information and use it yourself as well, logging in as a student, and see what you're good at. It turns out I did it myself 15 years after I graduated college, and it told me I should have been an educator or an instructor. And guess what? That's what I do. Only 15 years after I graduated did I find that out.
Okay, interesting.
I won't make jokes about how many girlfriends I've asked to take Hooter as well. Okay, so now let's talk about the ACT versus SAT. It's important that the student takes them. What we go through, because I haven't gotten there yet, and I scroll right past it anyway. The ACT has trigonometry. The SAT only goes up to algebra. The ACT has science. The SAT does not. So a student should find out which one they're better at and take that one over and over and over again. Practice test until they can do it. Basically, a student is expected to take the SAT or ACT at least 3 times. And it's a composite score. If you do well on one portion one time and better on another portion another time, they will take them both together. They will combine your highest scores. I'm not going to go through the SAT and ACT with you. By the way, this is the month where we update our numbers, so you're going to see some older numbers now. But the Department of Education doesn't come out with their updating numbers until the end of July, early August, so we will be updating those numbers as well. I'm going to try not to eat up the whole day here. Let's talk about negotiating. If you call a school and say, I want to negotiate, they will say, we do not negotiate. But if you say, I'd like to have it reevaluated, they will say, oh, sure, send us a letter. So we know how to evaluate aid packages. If it's a good aid package, we'll let you know. Or the family know. If it's below average, we will write a letter. But the student needs to apply to 6 or more schools. There's something I have to say about special talents and interests. This is students who are great at sports. Keep in mind, if a student gets injured, they will lose their scholarship. I had a student one time in high school that got into a school for band, for saxophone. He worked so hard, his GPA dropped below 2.5, and guess what? Yes, he ended up living at home with his mom, going to Broward Community College, and working part-time at the high school band. Okay, so one would want to work on the grades more than anything else. Early admissions and early acceptance are scary because the odds of getting accepted are greater, but you have to go to the one school that accepts you, and you cannot request reevaluation. So those are catches that they have to be aware of. I'm not going to go through the essay writing on how to do it, but you remember the good old MLA handbook that every English teacher told you to buy in high school, but you never did? Well, do what I did and take it out of the library and never return it and just pay the fines until they stop bothering you. Well, we explained to the student how to write, the structure of the essay, the formatting, and everything else, to write an essay that the essay assessors are ready to read. And we will review and critique the essays once they are written. Okay, I ran about 15 minutes, 10 minutes over, excuse me, but that's okay. We'll recoup and we can always go over it again. This is a very important page for you as a financial advisor. This is where the parents start showing you what they have. In this case, we made up a family. Ivy League. Get it? Ivy League. The student's name is Ivy, first name, last name, League. Anyway, $70,000 income, number of dependents, what their income and their assets are. So let's talk about the assets because this is important to you as financial advisors. Parents are allowed to have a certain amount of money, but then anything they have over a certain amount is assessed towards EFC. It's called the Asset Protection Allowance. Married parents are allowed to have, depending on the age or marital status. If they're married and 50, they're allowed to have around $22,000. But let's say in this case it's $20,000, okay? For ease of calculation. Anything they have over that, and by the way, divorced parents or single parents are allowed to have around $13,000. The interesting thing is that doesn't really matter in this training is that when I first started this in 2003, a 50-year-old parent who's married is allowed to have $48,000.
Wow.
Now, like I just said, a 51-year-old parent is allowed to have around $22,000. So they've greatly cut it down. The formula is the same, but they're starting to count assets earlier. Anything above it is assessed at 5.65%. I won't go into the details about why it's 5.65%, but that's what it is. Students are assessed at 20%. So that $20,000 that the student has is assessed from $1, by the way. So that's $4,000 a year before they qualify for aid. Now let's talk about the parents again. I love taking out my calculator and doing this. $100,000 above what they're allowed to have, assessed at 5.65%. Making sense so far? $5,600, $50 more per year before they qualify for financial aid. Multiplied by 4 years, wow, my $100,000 worth of investments and caused me to pay out $22,600 more for college costs before my child qualifies for financial aid. And that's just one child. That's an incredible amount of money. I'm going to show you something here that you might be amazed at. Here it is. This is the FAFSA. This is the paper FAFSA. Now, you can do it online. Everybody says you can do it online, but look how long this paper FAFSA is. It's actually 10 pages. When you get to page 9, the second to the last page, now it starts showing you, guess where it shows you? Investments do not include. This is second to the last page of the paper FAFSA. Who's going to get this far? Well, guess what? The FAFSA does not count the value of life insurance. The FAFSA also does not count annuities or the equity in your home or existing retirement plans or businesses with less than 100 employees. What parent is going to bother to look on page, the last column on the right of the second to the last page of the FAFSA, paper FAFSA instruction sheet? What parent even gets a paper FAFSA anymore? So I just want to show you in black and white what is not counted. So let's talk a little bit about that. So we have the parents' monies assessed at 5.65%, but if you put it in life insurance and annuities, they're not counted. You might have somebody say, well, I love my rate of return on my investment. Well, guess what? You have to have 5.65% rate of return after taxes just to break even. That's not such a good investment, is it? And you have no guarantees either. You can match a lot of these in index annuities, or if you're a registered rep, you can put it into variable annuities. People tell me, well, if I put money into an annuity, I only get 2%. I guess you're talking about a fixed annuity, aren't you? You're not talking about an index annuity or any other types of annuities out there. I don't have access to my money. Well, almost no matter what, even if you put an annuity into a, let's say a 10-year annuity with surrender charge, you can take out up to 10% a year without it affecting, without you being penalized anyway. Some people are going to say to you, well, I'm going to be hit with a 10% penalty when I take money out. That's a 10% penalty before 59.5 on the gains only, not on the principal. And with life insurance, you can borrow your own money from your cash value of life insurance. So you can put money into annuities and life insurance. And of course, we know it grows tax-free. So you have tax-free growth. It's not being assessed at 5.65%. And you can pick your beneficiary, and you have access to liquidity. So all these people say they don't really like annuities. It's because they don't understand annuities or life insurance. Students, by the way, can also be owners of life insurance policies. Now, in the old days, a student under 18 used to be able to put money right into an annuity, but not anymore. But a parent, believe it or not, but believe it, can take money out of a custodial account for a student and put it into an annuity for the benefit of the student, because the money is being used for the benefit of the student. Now, let's say the student has $20,000 put into an annuity. Well, they're not being assessed every year. They're in college at 20%. So let's run a quick set of numbers here, which of course I really shouldn't have to explain, but let's do $4,000 a year. That's a $20,000 being assessed at 20% over 4 years. Those parents, if they left that money in there, would be paying $16,000 more for college over 4 years in order to save $20,000. It doesn't really make sense, but you could put it in a 5-year deferred annuity. Once a student graduates, pull that money out, use it to pay off loans, buy a car, put money down on a house, I don't know, whatever you decide or they decide. And they pay a 10% penalty on what? On the gains only. You can put lump sums of money into life insurance. Of course, don't make them a MEC, but then they have other policies where you can use annuities to fund life insurance policies. I'm sure that if you deal with an IMO or an FMO or a GMO, since they're making money on your sales, thank goodness in insurance they're not taking your sales away from you. that you can then, they will gladly find you products that fit what you need. Because the more you sell, the more they make. So it's a win-win situation. So that's about the assessment portion on assets. Now let's talk about the income, the EFC from income. Parents are allowed to earn a certain amount of money. It's called the income protection allowance. Typically, it's around $31,000. Everything you earn over that is assessed at 47%. Let's talk about that. If I put money in a 401k or IRA, it's not hidden. The contribution is not hidden. Once it's in there, it's not counted, but the contribution is counted at 47%. And worse than that, let's say you're in a 10% tax bracket and you put $15,000 in a 401k, you might be saving, yes, $1,500 in taxes, but guess what? That means that, and the end result is that you've earned $1,500 more. So not only are you being assessed the $15,000 contribution, but you're being assessed at 47% of your $1,500 tax savings. The government does not want you putting money into retirement or taking money out of retirement while you have kids going to college. A viable solution would be, of course, if your employer is matching your contribution, put money in. You'd be silly not to. But if your employer is not matching your contribution, it might be something to think about if you're going to put money into a 401k or an IRA. So those are very important. Now, we're going to talk about gains in a moment, but let's first talk about students' income. Students are allowed to earn this year $6,400. And you're going to tell me what student earns $6,400. And I'm going to come back and say, and federal work study money isn't even added onto students' income. So you're going to say, so how is a student going to earn more than $6,420? By the way, anything more than $6,420, increase the EFC by 50 cents of every dollar above that amount. There's something on the FAFSA that I'm going to show you also. And the reason why I'm showing this is because it's hard to believe. But if you see it in black and white or blue and purple and whatever color, blue and purple and black and white, let's look at this. This is students' untaxed income. Here is where the kill. Money received or paid on your behalf, for example, bills. That is tuition bills. That's car bills. That's cell phone bills. That's car insurance. That's car repairs. Anything a student receives from any other entity other than the custodial parent is added onto income. This includes money you receive from a parent other than a person whose financial information is not reported on this form and not part of a legal child support agreement. In other words, if your parents are divorced and they don't have a child support agreement, all the money that the non-custodial parent contributes to their child is added onto the child's income. And the problem there is that when you talk about parent contribution, if a parent is receiving child support, it's added onto their income, which is assessed at 47%. So the government's going to get you no matter which way you decide to do it. And if you think you're going to skip out on it, the moment you pay a bill for a student to the college and the college sees it, or if it turns out you're being fraudulent, there could be a $20,000 fine, jail term, and loss of financial aid for the student. But what I really wanted to bring this up for is because I'm going to show you what happens if a grandparent contributes money from a 529. So let's take out the calculator again. Let's say grandma and grandpa don't want to give any money to the parents, but they'll give $30,000 to their grandchild, pay the bill. The grandchild's allowed to earn, let's say, $6,400, okay? Now that's $23,000 more than the child's allowed to earn before they're assessed. 50 cents on the dollar. They just increased their child's next year's EFC by $11,800 a year because grandma and grandpa didn't want to give it to their children to use for their grandchildren. We will have to talk about that. But even if it's 529 money, saving 10% at tax deferred and then having the distributions not taxed, does that really help you when a $30,000 contribution to your grandchild increase your EFC by $11,800 per year?
No.
No, it doesn't really make sense. Now let's talk about the parents, another issue with the parents. Let's say they say, I don't want to sell my investment. it's growing too much anyway. Well, guess what? If you sell it now and put it into an annuity or life insurance and it grows tax deferred, when you annuitize and you take distributions, you're only paying it as income. If you put $500,000 in an investment and it grows to $1 million, when you start selling it off, guess what? You're paying capital gains. You're not paying you're not paying it just as income. You're paying capital gains on $500,000 worth of growth. We all know, if you look at the charts, that that over time, tax deferred growth is much better than taxable growth. So that's one issue with capital gains. Now there's another, so better do it now, take the small capital gains and set a huge later on. Now, if you take a capital gain, it will be added onto your income, and your EFC one year will go up by 47% of your capital gains. Yes, they're going to get you, but the government only does a look back to, if you're going right after the senior year of high school, the government looks to your junior year of high school's tax return. If you reposition before December 31st of the sophomore year of high school, it won't show on the junior year tax or any other taxes thereafter. So you might really want to reposition assets before December 31st of the sophomore year of high school. But once again, even if you decide to reposition after, you're only getting hit with the increase in EFC of 47% of the gains 1 year and 1 year only. So you can even help students who are in their freshman and sophomore years of college if they're going to go on to a better school anyway. You might run into students who have a very bad GPA in high school, and that's okay. I had a friend who dropped out when he was 15. He knew everything. He knew more than everybody else did. At 21, though, he said, Steve, I got to get my GED. I said, Richie, you need to get your BA. He went to Nassau Community College. That's where we lived in Long Island, the Nassau Community College, for 2 years. Got a 4.0 both years. Moved on to St. John's College. We all have heard of St. John's. I think we have. The basketball team, good basketball team, law school. He graduated magna cum laude. A 15-year-old high school dropout graduates from St. John's magna cum laude.
Wow.
Colleges don't care what your GPA in high school is or your SAT or ACT scores once you're in community college. They just care what your GPA is in community college. Community colleges are much less expensive. You live at home also, and you save money on room and board. You get used to college life, and community college classes are much less difficult or competitive than four-year college classes. It's called the 2x2 method or strategy, where you go for 2 years to community college, and then you finish off your 4 years at a four-year college, and your employers don't care what school you started going to. Your employers care what school you graduated from. So there are a lot of things to talk about when we run into these reports. I'm just giving you examples. Now let's talk about 529 plans. I don't know why people sell 529 plans. Let's talk about the first problem. The first problem is this. The parents think that since they're doing it from day one when the child's born, they don't have to put in a lot of money. Lo and behold, after 17 years, they might have $30,000 saved up, which is maybe 1 year worth of college. Wow, what did the 529 plan do for me? I'm not really sure if it did much. Now, let's say we have the conscientious parents who are going to have 4 kids, and they're going to plan. They're going to put $10,000 aside every year from the day the child is born for 17 years. They have $170,000 now. That sounds pretty darn good. And who knows, they might have some gains. They've been very conservative, and they haven't put in $170,000 all in at once. Let's say it's a $30,000 gain. Now they have $200,000. Problem, 529 plans are assessed in the parent's name at 5.65%. Uh-oh. That first year before the child goes to school, they're expected to pay $11,300 in increased EFC before the student qualifies for financial aid because of that $200,000. Well, a lot of good that did. I saved $200,000. Now immediately I have to spend $11,000 more out of that. That's not really fair, is it?
Each year, correct?
Now let's say the parents spend $30,000 the first year. Now they have $170,000 left. Assessed at 5.65% the next year. add on the 20,000 whatever from the year before, the 11,000 from the year before, and now after 2 years they paid over $20,000 out of the $200,000 just because they had the 529 plan. I don't think 529 plan people know what they're doing. If you don't put in enough, it's worth nothing towards financial aid anyway. If you put in a whole bunch, it hurts. So if I were to run into a parent with $200,000, I might say, hey, you know what? Sell it. Now you have a capital gain of $30,000. What's capital gain tax? Let's say it's 20%, okay? 0.2. That's $6,000. But they took the money out of a 529 plan. They're going to get hit with a 10% penalty on the $30,000 gain. That's around $3,000, right? So would I rather pay a taxable taxes and a penalty of $9,000, or the first year pay $11,300 just that first year? Or after 2 years pay $20,000, and after 3 years pay $30,000, or one-time tax and penalty of $9,000.
Right.
That would be up to you to discuss with the parents, but the odds are they'll probably want to take that $200,000 and put it into an annuity.
Absolutely.
So these are things that 529 salesmen don't understand. It's not that they're bad people. It's just that they don't know. If the grandparents have it and they use it to pay for college, it kills the kids' EFC. If the parents have it and just have it, it kills the EFC also. So what do 529 plans do? I don't know. But people take classes in 529 plans, right? They have licenses now for 529s. I don't think anybody really knows the ramifications. And if a smart parent saw this and they ended up being in a situation that it was costing them this much money, who could they go after? I don't know if they can go after anybody. Maybe they can go after FINRA because it's an approved product and it hasn't been sold. It hasn't been misrepresented. It's just the ramifications. Okay, so now I went through all the good stuff. By the way, the CSS, the institutional methodology, only assesses things at 5%, not 5.65. It does count the business, but typically you take fire sale value of businesses, so it's not assessed as much. If you were to own a real estate, a rental property as a personal asset, you'd be assessed at 5.65%. If you put it in an LLC, guess what? It's not counted. So there are other ways to look at it. Now, non-custodial parents' income and assets on the CSS profile are counted, but because the schools provide so much more financial aid, it becomes a non-issue. And then you run into parents who have a $450,000 home. But guess what? So many parents who have a $450,000 home typically owe about $400,000, so they don't have a lot of equity in the home anyway. And then they should always take the lowest value of the home. You don't take the ZUSC price. You take the tax assessed price. I had an uncle that just died. He was tax assessed on $99,000 home, but it's selling for $287,000. So you can always look at the lowest price on there, not the price at school that the homes are selling for down the street. I'm not going to go through chapter 4 right now, just because guess what? Students assessed at 20%. Yes, I just went over that with you. Parents, students cash checking and savings, 20%. Yes, we know that already. CDs, if they have them, 5.65%. I'm not going to go through the section with you. We'll go through that step case by case basis. But now we get to chapter 5, which is always page 32, and it's always page 1-5-1. I'm going to paint the picture with this family. Now, this is a statement of their income and assets. Remember earlier, I said, depending on the parent's age and marital status, they're allowed to have a certain amount of money. This year, it's going to go to around $22,000, just so you know, about $300 more for a 51-year-old parent, which is really, compared to $48,000, like I said when I first started, is really hardly anything before you're assessed nowadays. But this case of parents, $21,700. In case you're wondering, there's a very important form that you luckily don't have to know about. This is the 36-page EFC formulary, how to calculate the EFC. It's free online. I can email it to you. I've had many affiliates tell me, oh, Steve, now that you sent me this, I can calculate anybody's EFC. Every affiliate I sent this to has calculated it incorrectly. Don't worry, our software does this. But there is a chart, just so you know, in this 36 pages, showing this is a newer one, by the way, at age 50, by the way, oh, sorry, I'm wrong, $22,900 before they're assessed. We're updating our database in a month, so don't worry about that. But anyway, in this case, it's $21,700 last year. So now we're going to paint a little picture. The parents have $210,000. That's everything. So let's start with $210,000. Now the home's not counted in the federal methodology, correct? Correct. Okay, correct, because I showed that to you on the FAFSA, so you know I'm not playing a game. So let's take off the $50,000. And we know that they're allowed to have $21,700 in assets before they're assessed. I just showed you the chart, so there's no games there either. $138,000 are being assessed on in assets. Multiply by, of course, 5.65% for parents. Don't worry, the calculator does work. I just have to be patient with the buttons. $7,800. But don't forget, let's say Little Ivy has $20,000 assessed at 20%. I could show you that as well. That's adding on another $4,000. Whoops, $4,000. Now we're looking at $11,800 a year. Okay, it looks all right, but let's look. Over 4 years' time, my investments are costing me almost $50,000 out of pocket. That doesn't make sense. So the way I like to explain it is this. I'm sure some famous author wrote this quote. I don't remember who it is. When I approached the forest, I saw it as a forest. As I walked through the forest, I saw it as the tree, the forest for the tree, the forest as the trees. When I got out of the forest, I saw the forest for the trees. What you're doing is you're walking the family through the financial aid forest. They see the big picture. Now you're taking them through the individual aspects of income and assets right now. So they're understanding by the time you're done with them and they're out of the forest of financial aid, they will see the forest for the trees and they will be asking you to reposition their assets. We do not have to make recommendations. All we have to do is show them what they have, how it's counted, and what the ramifications are. If you'd like, you can show them a copy of the paper FAFSA and show them what's counted and what's not counted. You are not making recommendations at this point. So what does this affect? What does this have? How does this affect the EFC? Well, with EFC from income and assets, $15,000 federally, $17,000 institutionally. If the assets in this case are not counted, it goes down to $5,000 from $15,000, from $6,600 from $17,600. That's very, very important. Especially over 4 years, it could be $44,000 worth of money out of pocket that's saved. Now, I made this joke the other day about additional students in college. If you have more than one child going at a time, you take that EFC and divide it in half. That would be $2,500 if you have 2 kids in college at the same time. I'm going to say this joke. Don't take it the wrong way, but you've heard of extreme sports, so let's talk about extreme long-term college planning. Instead of having a child every 3 or 4 years, so when one's graduating college, the other one's going in, why don't you really plan to have a child every year for 3 years? That way, when you have kids in college, you have 3 at a time, and you'll be taking that EFC and dividing it by thirds. So there's different ways of looking at college planning. Now we can talk about other things. So this is the FAFSA answer sheet. This is the line by line what is going to be entered on the FAFSA. There are some things here that are very important to understand. Lines 40 and 41 discuss the student's current balance of cash savings and checking and investments. Well, the parents already know because you've explained it to them that anything over $1 is assessed at 20% if it's not in life insurance and annuities or existing retirement funds or equity that your child has in a home. So ideally, what should these two numbers add up to if you don't want to be assessed at all at 20%? Zero. We haven't told them to put money anywhere. We're just painting the picture. They're in the forest now. Additionally, we come across the parents. Well, guess what? Cash, checking, savings, and investments. In this case, if the parents are assessed over $21,700, ideally these should be no more than $21,700. We haven't said anything about moving We're just letting them know, and now we've planted the seed in their mind. Once you're done reviewing the report with them, they might say, so what do we do? Now, why would they want to have their EFC lowered? This is the first portion of the report, by the way. So let me quickly touch back with this right here. Oh, wrong one. With this here. Nope. I'm trying to find the right, our promise. Here it is. Okay. So we're showing them the student profile report. We're in it now. They know what they're getting. We're showing them their EFC. We've explained a little bit about the CSS profile, but not much yet. We'll get to that. And the institutional methodology. We haven't gone to the college search. We're about to touch on that in about 30 seconds. We've gone through how to write an essay. We've gone through the idea of negotiating. They understand the SAT and ACT now. They understand about graduating in 4 years. We haven't gone over loans yet. That's okay. But you are now, suddenly, you are the senior college counselor because you're on your way to understanding what we do here. So let's go back to the report. This is the second portion now. I told you earlier I graduated with an electrical engineering degree. I don't care about good, better, best. I care about the numbers. So I like to go to the second section. If anybody's gone through Arizona State University, I'm not trying to insult Arizona State University. They're just a very good target. It's always page 48. It's what will college cost, or what I like to call the Can I Afford to Go chapter. What's the first thing we go over? Hey, it looks like a familiar formula, the cost of attendance minus EFC's remaining need. Well, hey, Steve, okay, well, at least you got back to it now. What does it mean? Let's talk about ASU. 42,000 people go to ASU, undergrads. It's a popular school. It really is. Everybody knows ASU. Out of state, 40 grand or $39,581. Now we're using the formula. What do we have next? The EFC. If you subtract the EFC from cost of attendance, you have remaining need. Well, Arizona State covers 68% of remaining need. Not terrible. In the whole scheme of things, not terrible. They're covering $23,000 of $34,000, not so bad. The problem is that they're covering 41% of the 68. Remember, 68% is 100% of work, study, and loans and gifts. So 41% of the 68 is work, study, and loans. That's not really that good, and you'll see why later on. But guess what? $13,800 is free money that doesn't have to be paid back. If the family did not reposition assets, they'd be paying $23,000. Well, it's less than $39,000. But if they reposition, it would be $16,000. Well, that looks a lot better, especially when I'm saving $7,000 a year. Or let's use some round numbers and say it's $30,000 over 4 years. That's a lot of money. And if we're only paying $16,000 a year, we basically saved 2 years worth of college tuition. That's not really bad either. But now let's get to the real world comparison here. Rice University, you might tell me, well, no one's going to get to Rice. There are many universities out there like Rice that use the institutional methodology that are really expensive. Let's subtract the EFC, the institutional EFC, and what's the remaining need of $53,000. Okay, where's that going to come from? Well, Rice covers 100% of remaining need. And you're going to say to me, well, okay, how do they do that? Well, 11% only is work, study, and loans, only $5,800. That's a lot more affordable, especially since the first-year student loan is $5,500. 89% is gifts, free money, $47,383. Now, you might tell me something like, Steve, how does the school have this much money? How do they come up with this magical amount of money? Well, I did something the other day, and I typed in on Google, Rice University endowments. And guess what? I'm highlighting it right now. Rice has $5.6 billion in endowment funds.
Wow.
You can look up any school you want on Google and type in Rice or type in endowment funds, and you will see this for any school you want in any state. Even if you have to bring up their yearly report, they will show what they have in their yearly financial sheets, their spreadsheets. So this
That was just for the year?
That's per year, 5.6 billion that they have to give
Wow, that's
out.
crazy.
This is why these schools can give out money. State schools don't have this type of money, but private schools do. There are other schools that have, I mean, I don't really want to waste time here, but should we type in another one?
Yeah, this is like really
How much does what school?
fascinating. That's
How much is what
crazy.
school? Name a school. How much does, let's say, Notre Dame have an endowment fund?
Hmm.
Let's see if it comes up quickly. It might not. Oh, only 10.4 billion.
Wow,
Flat for the year at 10.4 billion.
that's crazy.
Okay, so now you know. So I've showed you information from the FAFSA. I've showed you information from the Department of Education formula. I've showed you information. I know you can't always trust what Google has, but I mean, it obviously they all can't be wrong. So the free money is free money. So now what happens is you've shown the parents how to reduce their EFC. You've shown them what schools provide the greatest amount of remaining need, that they don't have to go to a $16,000 a year school for $16,000 if they're earning $100,000 a year. Now, let me ask you a question. Let's say a school's $25,000 a year. Would you rather pay 20, and your EFC is 25,000, 25,000 when you have an income of around $125,000, $130,000 a year. So a $25,000 EFC is absolutely, has been heard of. Would you rather spend $25,000 and send your child to a $25,000 a year school, or spend $25,000 and your kid has good grades because they know understand it now, and go to a $65,000 or a $70,000 a year school?
Yeah,
It's a
absolutely.
no-brainer in regards to financial aid. So now they're looking back at this farce of financial aid saying, oh my gosh, can you please rerun the report? We now want to change the schools that we pick. Can you please pick schools in a specific state or area of the country? Now we've gone to the CUDA Navigator and our student wants to look for a different major. Can you put that major in? Now we want the schools that cover 80 to 100% of remaining need. Can you please put that in? There are 400 schools in the nation that provide 100% of remaining need. More than that, I'm just talking 100% of remaining need. Rollins, only 80%, but still, if you reposition only $16,000 a year, that's not bad to go to a $63,000 a year school. That's not really too bad. USC, of course, 100%. Harvard, 100%. Well, Vanderbilt, which is a great school. Everybody loves Vandy. Elon, 100%. So there are many schools out there that provide 100% of remaining need. So I'm going to sort of end the training here because we've gone about the length of time. Obviously, there's so much more to look at in this report. If you were to go over it with the family, it would take you hours. But let's look at something here, and I have to touch on this. Arizona State University. Yes, I'm sorry, I'm doing it again. 17% graduate in 4 years. Now let's turn that around and turn it into numbers. That means that 83 out of 100 kids are not graduating in 4 years. 83 out of 100 have not graduated. Not very good. Only 46 out of 100 have graduated in 6 years. There's a problem there with the quality of education. Now, also, let's look at faculty-student ratio. 17 kids per every teacher, okay? Rice, 9 kids for every teacher. That's a lot lower, isn't it? About half. Quality of
Yeah,
education. And look at this.
the numbers.
71% graduate in 4 years, not 17%.
Yeah, absolutely.
So you might have parents that tell you that state schools are just as good as private schools. Now, I'm not saying that every state school is bad. I'm not saying that every private school is great. But if you have the opportunity to do the research, you can pick schools that you can afford to go to and that will provide a great education. If a school doesn't provide numbers, by the way, we don't make numbers up, just so you know. 73% graduate in 4 years. Odds are you're going to pay less out of pocket in the end to go to a private school than a state school. And I'm going to cover one last thing. Like I said, I can't go through all this information, and you can't either with the family. You'll be there for hours. But what you're doing is you're showing them that is definitely worth $16.95. Even if you cannot save money on financial aid, to understand all this information is worth it anyway. This is like a class in understanding financial aid, which guidance counselors can't provide to you. Outside scholarship, outside private scholarships is the last I'm going to talk about today. There is a website called fastweb.com. 1.5 million free scholarships on that website. First problem, you have to register. That means you have to put in your personal information and your email address. Well, you know what's being sold off immediately. That's your personal information and your email address. Now you have to apply for every single scholarship individually on this website. You go through a registration form, which shows you what scholarships you qualify for. Of course, that makes you think, well, at least there's a reason why I gave my information. Then you're going to come up against a bunch of scholarships. You have to apply for every single one individually. Every single one requires an essay. Everybody and their grandmother is applying for these scholarships. These scholarships are typically $250 to $500. They have to be renewed every year. Now you're going to tell me, what do I care? It's going to be free money. Well, guess what? You can look this up anywhere, and the question would be on Google or anywhere else you want to type, how do outside scholarship affect my financial aid package? I'm going to explain that to you now. By law, can a school give a student more money than the cost of attendance? That's illegal. By law, a scholarship company has to give the scholarship to who? Not the student. It has to give it to the school. So what does that mean? That means if the scholarship company has to give the money to the school and the school can't give it to the student, that means the school has to keep the money. Every dollar, if a school is providing with all the financial aid you need, every dollar you receive as an outside scholarship, the school will reduce what they're providing to the student dollar for dollar. I ran into a student who received $8,000 in outside scholarships. I didn't know at the time. I thought it sounded great. This is a long time ago, before I learned a lot of things. I called the school, and the school said to me, that's great, but we're already giving her $7,000 in scholarships. So of the $8,000 that we're receiving from her outside scholarships, we will only give her credit for $1,000. So if the school is providing you 100% of remaining need, every outside dollar scholarship you get from every dollar you get from outside scholarships will reduce what the school is giving you dollar for dollar. And that's normally when they have, I've heard this and I think it's true. The gospel always ends in good news. I would wish this could end in good news, but it doesn't. However, I've covered all the rest of the training, had good news in it. So I hope this was a successful training. I hope you learned a lot. Of course, if you have any questions, my name is Steve. You have my email address. And the phone number is 888-737-4123. Once again, this is the initial training. The trainings that follow, you will take the quiz online. We will review the quiz with you. We will then customize a seminar for you and make sure we review that over and over again with you until you are comfortable. We go through the one-on-one with you before you meet with the family so that you know how to sign them up. We will review every single report with you before you meet with the family. So this is an ongoing training. And like I said earlier, just because I've been doing this for a very long time doesn't mean there's not something else that I could learn and that I do learn every year. So I hope you all had a good day today. And if you have any questions, once again, please don't hesitate to get in touch with me. Have a great day.